Purpose and importance of disclosures under GAAP. Disclosures enhance financial transparency by providing context and clarity to the numbers presented in the balance sheet, income statement, and cash flow. Informing stakeholders of management judgments, estimates, and assumptions. Highlighting uncertainties, obligations, and legal exposures. Ensuring comparability across entities and time periods. Example, a reported net income of 10 million Nigerian nairas might seem solid until a footnote reveals a pending lawsuit that could cost 15 million Nigerian nairas. Categories of financial statement disclosures. GAAP-mandated footnotes typically include 1. Summary of significant accounting policies. 2. Revenue recognition. 3. Inventory methods. 4. Depreciation and amortization. 5. Leases, ASC 842, 6. Contingent liabilities. 7. Related party transactions. 8. Subsequent events, ASC 855, 9. Going concern assessment. 10. Debt and covenant compliance. 11. Fair value measurements, ASC 820, 12. Segment reporting, ASC 280. This is the first and most foundational disclosure. Common policies disclosed: revenue recognition method, e.g., point in time versus over time; inventory costing method, e.g., FIFO, LIFO, weighted average; depreciation method, e.g., straight line, double declining; basis of consolidation for subsidiaries. Use of estimates. GAAP requires companies to disclose accounting policies that are most significant to the financial statements. Contingent liabilities and legal exposures. Disclosures are required if the loss is probable and estimable: lawsuits, environmental obligations, regulatory penalties. If not estimable, companies must describe the nature and status of the contingency. Example, a chemical firm under EPA investigation must disclose potential liabilities and status of proceedings, even if outcomes are uncertain. Leases and off-balance sheet items. Under ASC 842, GAAP requires all leases, except short-term, to be recognized on the balance sheet. Footnotes must disclose nature of leases, lease term and payment schedule, discount rate used, operating versus finance lease classification. This eliminates off-balance sheet financing loopholes, ensuring debt visibility. Going concern disclosures. If there's substantial doubt about an entity's ability to continue for the next 12 months, management must evaluate viability. Auditors assess management's plans. Disclose factors threatening continuity, such as liquidity problems or pending default. Failure to disclose going concern issues is a severe GAAP violation and a trigger for qualified audit opinions. Related party transactions. These are transactions with owners, subsidiaries, executives, family members of executives. GAAP requires full disclosure of nature of the relationship, transaction terms, impact on financials. Example, a CEO's family leasing property to the company must be disclosed, even if arm's length. Fair value measurements, ASC 820. Companies must classify assets and liabilities into Level 1, 2, or 3, Level 1, quoted market prices, e.g., stocks; Level 2, observable inputs, e.g., interest rates, credit spreads; Level 3, unobservable inputs, e.g., private company valuations. Each level has different disclosure requirements to reflect valuation risks. Segment reporting, ASC 280. GAAP mandates disclosure of revenue by business segment, operating profit/loss, assets per segment, geographic areas, if material. This provides investors with insight into which parts of the business are profitable or struggling. Segment reporting, ASC 280. GAAP mandates disclosure of revenue by business segment, operating profit/loss, assets per segment, geographic areas, if material. This provides investors with insight into which parts of the business are profitable or struggling.